So yesterday I told you guys, I said at the Fed meeting, it could go one or two ways for interest rates. If the Fed's talked about inflation in a positive way, meaning that they feel like it's heading in the right direction, we would see interest rates improve. We'd see a rally in the bond market. What happened? Let's take a look at the charts. What you're looking at right now is the one-day movement chart for the 5.5% mortgage coupon, which I get that's totally confusing. You're like, what is that? Basically, just understand that on this chart, if it goes up, that's good for interest rates. If it goes down, that's bad for interest rates, okay? So as you'll see, basically when you get to about 2 p.m., which is approximately when Jerome Powell said basically that the systematic bank failures that have been taking place were not going to trigger further tightening. Because remember, everybody's focused on like, hey, are you going to tighten? Are you going to continue to ratchet up the Fed funds rate? Are you going to reduce your balance sheet? All of these things that affect the monetary supply, which affects bonds, which in turn affects mortgage interest rates, which is what I'm talking to you about right now. So literally, Jerome Powell basically gave the market some confidence by saying, hey, we're not going to ratchet things up because of all this stuff that's going on in the banking sector. And then as the conversation, as his press conference continued to go on, and he kept using the term disinflation, disinflation, disinflation. In fact, he had joked when one of the reporters asked, they said, hey, you used disinflation 12 times. And he was like, well, I was actually asked about it 12 times. But it was a key focus of the conversation. Inflation is not gone. It still exists. However, they feel like it's heading in the right direction and that their monetary policy is heading in the right direction, which is good news for mortgage interest rates. And that's why we continue to see the bond market react accordingly. And as of recording this video, we're up 80 basis points. That's a lot in one day. Not the most we've ever seen, but it's definitely a lot for one day and a step in the right direction. Now, this doesn't mean that we're out of the woods for higher interest rates. This doesn't mean that rates are at 2% all of a sudden. We still need a lot more economic data to come out that shows that inflation is going down, which in turn will stop eroding the value of bonds and you'll see interest rates come down, okay? But like I keep saying, they're heading in the right direction. Next thing that's like a big thing for interest rates is going to be the PCE. That's the Personal Consumption Expenditures Report, which is the Federal Reserve's favorite measure of inflation, okay? It measures inflation at the consumer level on all sorts of goods and services. And so next week, we'll be getting that report along with a bunch of real estate data. We'll keep you posted.